Starting with $0 is widely perceived as failure, but in reality, it can be one of the strongest strategic positions a person can occupy. When there is nothing to lose, there is also nothing anchoring you to fear-based decisions. Wealth is not built from comfort, it is built from clarity, flexibility, and controlled risk-taking. People who already have money often carry the burden of protecting a lifestyle. Their decisions are defensive. Someone starting from zero has the rare opportunity to be aggressive, adaptive, and fast. The absence of assets removes psychological paralysis. There is no expensive home dictating your location, no debt-fueled lifestyle dictating your choices, and no social pressure forcing you to maintain appearances. This freedom allows you to optimize every decision around growth rather than preservation. In financial terms, preservation is only relevant once something meaningful has been built. Before that, growth is the only rational priority. Another overlooked advantage is the low cost of failure. When capital is limited, mistakes are small and survivable. A failed attempt may cost time, effort, or a few $100s, but it does not destroy your financial future. This makes experimentation not only possible but necessary. The learning curve becomes steeper and faster, and lessons are absorbed with greater intensity because they are earned through direct experience. Time is another factor that works differently at this stage. While compound interest has not yet worked in your favor, it also has not significantly worked against you. Financial damage compounds only when poor habits are repeated for decades. A reset point interrupts that compounding effect. Starting with nothing forces you to examine behavior, decision-making, and assumptions about money at the root level. Most importantly, starting from zero creates urgency. Urgency sharpens focus. When comfort is removed, distractions lose their power. The individual becomes highly selective about where energy, money, and time are spent. This selectivity is a core trait shared by disciplined investors and financially successful individuals. The real risk is not starting with nothing. The real risk is drifting without a plan while hoping circumstances will improve on their own. A zero starting point combined with a clear plan is far more powerful than moderate income combined with confusion. The advantage only exists, however, if it is acted upon with discipline and intention. Financial recovery begins by stopping the outflow before increasing the inflow. No financial plan can succeed if money leaves faster than it enters. Before discussing income growth, investing, or wealth creation, the first priority must be stabilizing cash flow. This step is not glamorous, but it is foundational. Ignoring it guarantees failure regardless of income level. Spending is not merely a numbers problem, it is a behavioral one. Most financial stress is not caused by insufficient income, but by uncontrolled lifestyle inflation. When income rises, expenses quietly rise alongside it, keeping the individual in a constant state of pressure. Resetting finances requires reversing this pattern entirely. Every expense must be examined without emotion. Subscriptions, convenience spending, brand loyalty, and comfort-based purchases must be evaluated purely on utility. If an expense does not directly support survival, health, or income generation, it is optional. Optional expenses must be removed temporarily to regain control. This phase requires a mindset shift. Comfort is not a right during recovery, it is a reward after stability is achieved. Living below perceived standards for a defined period is not deprivation, it is strategy. Short-term discomfort creates long-term leverage. Reducing expenses has an immediate and guaranteed return. Unlike investing, which depends on markets and timing, cutting unnecessary spending produces instant results. Every dollar not spent becomes available capital. This capital can later be redirected toward opportunity rather than consumption. Another benefit of aggressive expense reduction is psychological. When spending is minimized, financial anxiety decreases because fewer resources are required to survive. Lower burn rate equals higher resilience. This resilience provides breathing room, allowing better decisions under pressure. Importantly, this phase must be time-bound. The goal is not permanent austerity but rapid stabilization. A defined period of strict control, such as 12 months, creates a clear finish line. Knowing that this phase is temporary increases compliance and reduces burnout. Stopping the financial bleeding is not about punishment. It is about reclaiming agency. Once outflow is controlled, every additional dollar earned begins to compound progress rather than disappear into invisible leaks. Income expansion must precede investing. When starting from zero, investing is often promoted as the universal solution to financial problems. But this belief is deeply flawed when applied to individuals with little or no capital. Investing magnifies existing conditions. When capital is small, returns are small. When income is insufficient, investing alone cannot create meaningful change within a reasonable time frame. The correct priority at this stage is income expansion. Increasing earning capacity creates leverage. It accelerates savings, shortens recovery time, and enables real investing later. Without sufficient income, even the best investment strategy becomes irrelevant. Income growth requires temporarily shifting focus away from passion and toward value. The market rewards utility, not personal fulfillment. Skills that solve problems, save time, generate revenue, or reduce costs command higher compensation. Identifying and monetizing such skills is the fastest path forward. Selling time strategically is often the first step. This may involve working longer hours, stacking multiple income sources, or accepting work that is not emotionally fulfilling but financially efficient. This phase is tactical, not permanent. The objective is capital accumulation, not career perfection. Multiple income streams provide redundancy. If one source falters, others sustain progress. This reduces dependence on any single employer or client and increases negotiating power. Diversification of income is as important as diversification of investments later on. Income expansion also builds confidence. As earnings increase through effort and skill development, financial identity shifts. The individual begins to see themselves as capable, adaptable, and in control. This psychological transformation is critical for long-term success. Attempting to invest before income is stabilized often leads to forced liquidation during emergencies, which destroys both capital and motivation. Building income first prevents this cycle. Once income exceeds basic needs by a meaningful margin, investing becomes sustainable rather than stressful. In summary, income is the engine, investing is the accelerator. Without a strong engine, acceleration is meaningless. Cash reserves create psychological and financial stability. Emergency funds are frequently dismissed as inefficient because they offer low returns. This criticism misunderstands their purpose. Cash reserves are not investments, they are insurance. Their value lies not in growth but in protection and optionality. When emergencies occur, and they always do, those without reserves are forced into debt or liquidation of long-term assets. This locks in losses and resets progress. Cash prevents this outcome. Beyond practical utility, reserves provide psychological stability. Decision-making improves when fear is removed. With several months of expenses saved, choices are made from logic rather than desperation. This clarity leads to better career moves, investment timing, and negotiation outcomes. Cash also buys time, which is the most underrated financial asset. Time allows for patience, research, and selectivity. Without time, individuals accept unfavorable terms simply to survive. With time, they can wait for better opportunities. Building reserves requires consistency rather than brilliance. Regular saving, combined with controlled expenses and increasing income, accomplishes this goal. The process itself reinforces discipline and reinforces long-term thinking. Reserves also mark a transition point. Once established, the individual moves from fragility to resilience. Financial setbacks become manageable inconveniences rather than catastrophic events. This shift dramatically changes one's relationship with risk. Only after reserves are secured does investing become appropriate. At that point, capital can be committed with confidence, knowing that short-term volatility will not threaten basic stability. Wealth is built through discipline, not moments of motivation. Long-term financial success is not the result of singular decisions, but of sustained behavior over time. Motivation fluctuates. Discipline remains. The difference between those who succeed and those who repeatedly reset lies in consistency. especially during periods when enthusiasm fades. The most dangerous periods are not during hardship, but during comfort and celebration. As progress accumulates, the temptation to relax standards increases. This is where many reverse their gains. Protecting progress requires vigilance, particularly during high spending seasons and emotional moments. Discipline also involves delayed gratification. Choosing future stability over immediate pleasure is the defining trait of wealth builders. This does not mean rejecting enjoyment indefinitely, but rather sequencing it correctly. Planning cycles reinforce discipline. Regular reviews of income, expenses, savings, and goals maintain alignment. Adjustments are made proactively rather than reactively. This transforms financial management into a system rather than a struggle. Equally important is identity. Once an individual begins to see themselves as a builder rather than a consumer, behavior aligns naturally. Decisions are filtered through long-term impact rather than short-term emotion. Year 1 establishes defense stability, reserves income. Year 2 enables offense, investing, ownership, and strategic risk. Discipline is what bridges these phases. Wealth is not an event. It is a trajectory. Staying on that trajectory requires commitment long after the initial urgency disappears.